Hey guys, it's Big Mike, and like always, I'd like to thank you for being here today. Today we have another Ask Me Anything with FuturesTrader71. The AMAs are designed to be quick and casual. They're limited to 30 minutes. There's no prepared presentation, and we'll do our best to get all the questions answered today. As you guys have questions, you can type them into the questions box, and FT will take a look at them. Also, the recording for this we posted on YouTube a little bit later today. If you are watching the recording at a later date, do me a favor and give it a thumbs up if you like it. All right, and with that, I'm going to go ahead and turn things over to FT. FT, are you there?
Hey, Mike, you there?
I'm here. How you doing, man?
Okay, it cut off while you were switching over.
Oh, sorry.
Hello, everyone. Let me start by saying that derivatives trading involves substantial risk and is not suitable for all investors. Past performance is not indicative of future results. What questions do we have today?
Let's see. We've got a few already. So Option Profit has a long question, a three-part question. Let's see if we can do this. If you ever have, what was your longest losing streak using a proven positive expectancy strategy while executing proper risk management? That's his first question.
Holy cow. I'm not a systematic trader, so I can't say. The only way I know I have a positive expectancy is because of my trading record as a trader. So I don't. I guess what you're asking is how long was your longest losing streak after you've made the turn? I think is a simpler way to ask that question, the way I understand it. And I think the longest losing streak I've had is probably, I would guess, I think I had a really rough time in early 2006, and I think I went like 5 weeks of just grinding sideways to losing slightly. This was well after I'd made the turn, and actually I was running a prop shop, and I think a lot of it had to do with my environment. I'd moved to DC and had a T1 point-to-point line back to my office in Chicago, and my trading environment was just not proper, and I just did not do well. So I ended up coming back to Chicago.
Okay. Before I move on to the rest of his questions, I want to ask you real quick. Is there any what do you recommend for people to become familiar with the probabilities of how that stuff can play out? Too many people seem to only focus on, hey, 50% win rate, so therefore half of my trades should be winners, and they're not setting themselves up mentally for the streak. You know, they're not using any type of a Monte Carlo or a probability spreadsheet or something that says, hey, even at 50% on a smaller sample size, you can have, 9 losers in a row or whatever it is. Do you have anything? Do you have a spreadsheet or anything that you use or some tool that you use to try to hammer that home with people?
So you're asking, the point that to hammer home is that even with a 50-50 kind of win rate, that you cannot you can't predict what the next trade is going to be. Is that what you're asking?
Yeah, I mean, I don't want to get us in trouble because that seems to always be a topic that people have contention with on the next trade stuff. But I'm talking about, smaller sample size. The 50-50 is over a larger sample size, and people don't know the probabilities that on a smaller sample you could have 8 losers in a row, even with the 50%.
Correct, and it's because and it's mainly because the flow of opportunities to win or lose in trading is infinite. The contention that I have, and I did actually in my first live talk on this on Friday, in front of a live audience downstairs here. And I used the example of I took 10 people from the class and I said, look, I'm going to sell you a 90% winning system. And I counted 10 people. and I said, I'd like you to talk amongst yourself and decide which one of you will be the losing trade. You know, and they just give me a weird look. What? How do you figure that out? You don't. You can't figure it out because you don't know where that one loser out of 10 is going to be.
Yep.
It could happen at the very beginning, and because the market's infinitely changing and is varying, and the market's just a price measurement of people's sentiment of whatever product or commodity you're trading, the probabilities are constantly changing, just like they would on, say, a moving average. So, you know, with a losing streak, you have no choice as a trader but to keep taking whatever the next setup is, unless you start to look at, you know, the possibility that something in your system has changed dramatically enough that you cannot continue to trade it. A simple example of that is a mean reversion system that has been created and has been used in a low volatility environment, and all of a sudden volatility explodes. The average day range in the ES, for example, goes from 12 points to 40 points, and you're still using 3-tick stops. That's a system that's going to, you know, cause death by 1,000 cuts. And you have to. This is why I teach context. Context is so important. You have to look at the big picture.
So the remaining two questions from Option Profit were on this losing streak. How did it affect your psychology and confidence going forward to the next trade? And then, was there any important takeaways that impacted your trading in a positive way after that?
Really good question. So it has a tremendous negative impact on your confidence. This is true for anybody that is in a performance environment. If you're a pitcher, you know, a baseball pitcher, and you have a great record and you get this awesome contract and you have endorsements and stuff, and then all of a sudden, you know, your pitching goes to hell, and with every pitch, you're getting closer and closer to disaster. I don't care who you are, it's going to impact you. Now, this same issue presents itself at the very beginning when people are learning to trade. They're dealing with that exact issue. As your confidence goes down, your emotional capital, your confidence level goes down, the void is filled with fear. Fear goes up, and fear causes all kinds of hesitation, overthinking, and things like that. The only thing that could save you in that situation is to be clear about what you're doing and to be comfortable with what you're doing and to just take the next trade while limiting your risks. So that's what I did. I hit a streak, a terrible streak. It just felt like all of a sudden I just could not trade anymore, whereas on a consistent basis I would go months without having a single losing day. And it basically brought me back to, okay, where am I with my plan? That's where a journal, keeping an electronic journal or a long-term journal is so key. And I had lapsed and didn't do that for like 2 years. Keeping a journal just helps you go back to regaining the mindset you had when you were doing well. The market does change, but it does not change so quickly that all of a sudden, you know, it puts you out of business. It's rare that it does that. So that's what I did. And then the takeaways were to be diligent about keeping a record, keeping a journal, and keeping performance metrics on your trading and how things are going. That's why we have the trade analyzer and so forth to keep track of how much heat you're taking and all that stuff. It's very, very important because that's what you fall back on when things get wacky.
Right. Pavel asking if you have recommendations for learning market profile in the way of books. He says, is Mind Over Markets enough, or should he also read Markets in Profile?
So those cover market profile itself. I've evolved from market profiling to volume profiling simply because we have tick data that gives us the exact number of contracts that traded at any given price. I started with Mind Over Markets and Peter Stadelmeyer's book. I would suggest Mind Over Markets, But really, I think at the first 3 chapters, and then I found the rest of it is just a massive snoozer. It was just really boring. Markets and profile is okay. It's an improvement, but it's not a huge thing. I think that one resource I would suggest is to go to my website, FuturesTrader71.com, and go to like the early chats, not the webinar series for my charity. I have 4 webinars that I did for my charity to raise funds back in 2010. Those kind of break it down into something more of a course. But if you don't want to pay that, that's fine. Just go to the earlier chats, and I cover the basics. But do read Mind Over Markets, at least the first 3 chapters, so you understand that the market, no matter if you're trading a stock or an option, or not an option, but if you're trading a stock or a future or whatever, ETF or whatever, anything that has volume, Forex, and so on, it's all an auction. It's an auction, and you should understand how an auction operates, and then it helps you detect when markets change. And that's basically what I've built my current structure on, is approaching things from the view of an auction.
Rex asks, how does velocity affect the trade in general for a given level? For example, if price is approaching a composite low volume node and you're looking to fade, what's the difference if price moves very quickly in a short period of time versus price moving slowly or meandering around to reach that same level?
Okay, good question, Rex. So a composite low volume node is on my screen. You can see my screen, I hope. Right? Can you see my screen?
Yeah. Sorry. Yeah.
What do you guys see? Okay. So let's say we're approaching, we're at new highs, so I can't really demonstrate anything with the recent action. But let's go back to the days when we were below a composite low volume. So a composite low volume node, this is a composite profile. This is all of the volume. This is a histogram of all of the volume that has occurred at each one of these prices going back to October 9th, 2013. A composite low volume node is a notch out, a low volume notch out in the composite at any given price. Like 55.25 has been a price that I've played quite a bit. In fact, if I go to the current, you can see that it's marked because it's a key area that the market has tested. If the market's coming up to this composite low volume node at 55.25, for example, and it does it very quickly on a large rotation, it goes to 1844, pushes up, pulls back, and then pushes into 55.25, which is a composite low volume node, which is an area of interest for me to trade. If it does it on a high rotation, if it pushes at it parabolically at, say, 7.5 or 8 point move without a single pullback, 6-tick pullback, then I'm much more interested in that price than if it starts to put in small bars and it's walking towards it and it's walking towards it. So the velocity of the market coming to that low volume node, if it's very, very slow, there's a tendency for the market to kind of continue to rise in a dull market or in a very compressed low volatility market. And I find that very hard to, I tend to sit that out and let it overshoot, then start or high velocity to that level in one big rotation. To me, historically, probabilistically, it's not a sustainable move. Generally, the market does not move 8.5 points or whatever and just keep ramming through unless there's news, unless something has changed. And so generally, if I can get it at 7.5 or 8 points and it's pushing towards that CLVN or whatever market level I'm interested in, that's when I'm stalking it more aggressively. I'm not going to wait for the market to start to make its rotation before I hit the bid.
Okay. Oliver's asking if you can explain how you balance recent high volume or low volume nodes with historically significant ones. Like, how do you weight them as to what's happened in the recent past, versus what's been happening in the long haul? And you kind of just touched on it, but any further comments on that?
Yeah. So this is an ongoing discussion that we have in our chat room. and the analogy I use to explain this is if you're building a foundation the old way, what you would do is you would dig a hole and then you'd put big boulders on the ground. You'd put big pieces first. Then you would be left with spaces in between those big boulders, and you take smaller, you take rocks and stuff it in those spaces. Then you take hand-size stones and put them in between that, and then you fill it with gravel, and then that way you establish a base, right? This is a kind of building a home back a couple hundred years ago or whatever. The way that analogy of the foundation of the auction is the same. I look at things, certain key things as boulders. They're the big pieces that you cannot ignore. A boulder is 6450, and the fact that we have basically meandered around it for 3 months, that's a big boulder. So if we're within range, I look at this as a key thing to note. However, if we are, for example, if like we did on this last Thursday, we pushed up and tried to push towards that last high at 85.75, and we got to 84.75, we started to break through, and we closed at the bottom of this day. This becomes important, even though there's a boulder here. This, I would consider the fact that we left the upper distribution and closed at a lower distribution, I'd consider that to be a big stone or a big rock in this foundation. Yes, the market's attracted back to the most traded price here at 64.50, but it has left the upper auction from Thursday and went to the lower auction. So on Friday, if you go back and look at my Trader Bite on YouTube on Friday morning, I talk about 75.25 quite a bit. And here's the market, here's the high of day, it's 75, just a tick short of it. This becomes important because it's more recent information. I carry this in the context of this bigger HVN, this composite HVN, which is a big foundational piece. This describes the auction for months, but the action on the prior day becomes an important thing. So I place that next. I say, okay, the big picture is we came all the way back, 65 even on Thursday, just 2 ticks above this key price, and then we closed up here. The expectation is the market will test 64.50, which it did. It went through to 62.50. And then once it finds buyers, it's probably going to test the 25.25, and there it is. 75.25, and there it is. It stopped at 75 even. So this is a boulder. This is a rock. The prior auction is a rock. Another rock, for example, is the fact that the market opened here. The expectation is it would fall yesterday and retest to 75.25 again. It did not. That becomes the rock of the day. Now we've left the boulder behind, but here's an important piece of the foundation of the auction. The fact that we had a chance to push lower, and we tried twice that morning, but we could not, and then buyers came in. Do not fade this rally. And that's why if you look on the Twitter feed, it'll say caution shorts. So that's how I place the importance. I have the big pieces in mind from the composite or the micro composite, but then I have these rocks that I place in between the boulders that I can trade around. And to be honest with you, I'm a pebble trader. I'm just looking for 2.5, 3 points, 3-point rotations within all these big structures. I'm not a swing trader. So that's how I kind of place things in order of priority.
Okay. Hal is asking what the purpose is of the zigzag on your chart and how you interpret it.
Okay, so that's the zigzags are really important for me to see what the market rotations are. So these zigzags here are all they are is the software detects the high or the low, and it continues to measure that high or low as one rotation as long as there's not a 6-tick pullback, because that's what it's set to. Oops. It's set to 6 ticks. So if the market makes a sustained move without a single 6-tick pullback, so you can see here from 98.50 to 93.50, it was one move and there's not a single 6-tick pullback, so that's 5 points. There was a 5-tick pullback here, so it didn't reset the zigzag. And how I use this is to measure how the auction is moving from the buyers to the sellers. So if I see this and I see that, okay, the early move was 1.5 down, 2.5 points up, 2.5 points down. Oh, you know, this might drop here. It's equal. This rotation down is higher than the 1.5 early, but then we got a 3.5 point rotation up. That tells me that there's more aggression on the buy side. And then so here on this rotation here from 3 to 5, this is the largest rotation of the day, and it's a down rotation. So the expectation now is that the market will test and retest VWAP or mid, and it'll try to continue lower into yesterday's range, which was my primary hypothesis for today. It didn't really work out, but this is how I use those zigzags, is to see, like, compare the current rotation to the last rotation, because that's what I'm really trading. I'm trading those rotations. I'm studying and trading those rotations. And I know that the standard rotation for the ES is somewhere between 2.5 and 3 points. And when I see a 5-point rotation, that means that a bigger time frame player has just stepped in and pushed the market in a single direction, probably, because this is an abnormal rotation. So now the short side's got my attention based on today's action, okay?
All right. LW asking, or says that last night you sent a tweet saying you're going to go risk off. Can you elaborate on that?
Yeah, I was up looking at just longer-term charts to see if it's time for risk to come off on long-term investments, on long-term positions. You know, this market's been running up and up and up and up with very, very shallow pullbacks, but I'm seeing a lot of anomalies to the way it's making these new highs. One I covered in today's Trader Bite in the morning, where we made this almost parabolic high here overnight yesterday and through yesterday's session, yet the delta, the volume delta, which is the sum of trades at the offer, you know, people buying at the offer minus people selling at the bid, this continues to drop. In other words, the market's moving up, but it's doing so on less aggressive buying. And then among other things, you know, the fact that we've been in this balance zone since February 14th, and then we finally break the high of this balance zone at 92.25, and we broke it by 4 ticks yesterday. There were no stop runs. There was no new interest in buying. I did not see a spike in the delta. Look at the delta here. The best it could do is 25,000 contracts buying more than selling yesterday. To me, that's kind of troubling. And we're approaching 1900, so I started to look at long-term positions and looking at where I want to reduce some of the risk, to take some risk off. I think the bull market's still healthy and it's still intact, but if you're holding long-term positions and you can scale out, this is what I was looking into.
Terry says, what qualities do you look for in prop traders?
So the key quality is competitiveness. So after vetting through a bunch of people and after trying to train floor traders and so forth, I discovered that the key thing to look for is somebody who has almost like a primal aggression, like they're competitive, but also knows that about themselves. And the people who know this best are athletes. Athletes are very intuitive, especially competitive athletes, seeded tennis players, somebody who played college basketball or lacrosse or football. Football I didn't back any. That's too much aggression for me. But those kinds of people where you know you can push and be primal in your behavior and be aggressive in your behavior when the situation warrants it, but you know that about yourself and are able to be disciplined and to follow a plan, follow a strategy when it's in front of you. That's so key, because the hardest part about trading is not teaching you about the auction. It's not telling you how to use a charting system or how to click to buy or sell or to use an indicator or whatever. That's where most people concentrate their effort, is on knowledge, gaining knowledge about the market and about their software. That's, in my opinion, that is not where the results come from. The results come from knowing and understanding how you operate under duress, under stress, and especially being able to control that chimp or that monkey that's in your head, that's the primal part of you that wants to fight the market. And we'll give back a month's worth of small gains fighting the market. That's what I don't want. I don't want to be a therapist for these traders, although that's basically what I was. I was a risk manager and a therapist more than I was teaching them anything. So that's what I look for.
Any comments on that same subject regarding risk, risk averse versus risk seeking?
Risk averse versus risk seeking is a gosh, that's such an awesome subject. People think, hey, I'm risk averse. I'm a dentist and I've always been conservative with my practice and I've always been. No, you have both. You are risk seeking and risk averse depending on what charge you have towards the activity. For example, if you get held up by a mugger, are you someone who will, will step back and shiver at the knees and hand over your wallet, or are you someone who will hand over his wallet but look for an opportunity to punch a guy in the face? And people change. So as you get more confident, the first thing I'm going to tell you is watch your risk, because as you get more confident, you start to see some sort of results for your effort. The first thing that's going to happen, in most cases that I've noticed, is that you start to become risk-seeking. You start to bend your rules. You start to want to trade more size when you're not prepared to do that, things like that. But if you've gotten damaged through losses, excessive losses, losing control, or not following your plan, or surprising yourself, or not exercising your discipline, then what's likely to happen is you'll become more and more risk-averse, which means there's more fear in your trading. So we go back and forth depending on not only the activity, but depending on our relationship with that activity and what kind of an emotion does it trigger within us.
Yeah, I think that's actually a contender for a really good webinar one day, maybe, is risk averse versus risk seeking, because it's very hard to be in the middle.
Yeah,
they seem to go from one extreme to the other, and it has really dramatic effect on your trading.
Yeah, exactly.
Peter says, or asked the question, are you familiar with market delta, and how would you compare and contrast it with Investor RT that you're using?
Okay, so I've used market delta. I used it for about a year, and it's when I first came on Twitter about 5 years ago, I was actually using market delta. I've known Trevor since '03, I think. The thing with Market Delta is it's a really great piece of software. Market Delta is built on the same engine as Investor RT. They're fundamentally the same product, but Market Delta is enabled for the footprint and several other things that Investor RT does not have in it. It's probably a matter of some white labeling and a switch being turned on or off for Market Delta. The reason I stopped using Market Delta and I went back to Investor RT is because I felt that Market Delta, people were getting Market Delta just by seeing my charts and stuff, and I felt that it was too much information. So Market Delta is great for when you've got your charts set up and you're technically aware and are doing okay already, and you want to enhance your entries or your look at the market by looking at footprints and things like that. It's great for that. But for me, it was too much information. This is my personal opinion. It was just far too much information, and I'm getting that information from the dome. So if I'm stalking to get short right here, I can see and feel, just by having watched the dome for years and years and years, I can see and feel which side is more aggressive. I don't need to see green and red boxes to tell me that. And what I've noticed is that people who've tried to use it, who are struggling or trying to learn to trade, we're getting caught up in all the different numbers and the colors and all that stuff, as opposed to focusing on execution, where it all. So the plan gets thrown out because they see a delta divergence on the footprint, and even though they've been telling themselves to go long, they see a delta divergence and they want to get short because of the numbers that they see. And so I stopped using it and I went back to Investor RT, basically the same charts, just without the footprint. They're both great pieces of software. Investor RT is a lot less expensive, but I don't use the footprint in my trading. Some people find it useful, some people don't. It's just a personal opinion.
Okay. Let's take one final question. Rex says he has an alert for the bond market, the 20-year, and when he hears new high bonds continually, he interprets it as risk off, and hence money coming out of the stock market and into the bond market, or vice versa. Do you pay attention to this and its relationship with the ES or other indices, and if so, in what way?
So I have the same alerts. I have day alerts on across many different products, crude, gold, bunch of different things, including bonds. You're assuming that the correlation is consistent, and it's not. So you could have new high bonds, new high bonds, new high bonds, new high bonds going on for minutes and minutes at a time, and the ES will just sit there sideways, not move. And the reason being, though, if you plot the correlation between those two products, and most software can, you could just plot one instrument over another and see how they're correlated. There are many things that could cause a bond to make new highs. I could be buying bonds in the futures and selling to hedge options and selling options. I could be buying bonds and selling TLT. I could be, so trading across products is not something I'd recommend, although that's how I started my career, is comparing different products and then going with the one that has not responded to a move yet. Just made a lot of money doing that, but that's not something that the markets are much better arbed now, arbitraged, and those opportunities don't show themselves very often. Like, seeing the Russell sell off hard and then selling the ES, you better be willing to sit through it for a while before the ES can respond. And what you'll find out is the ES will sit there, the Russell will sell off and make new lows, then the Russell will come back, and then the ES will start moving up with the Russell moving up. So trading across products is a very challenging way to trade, because it doesn't have a deep contextual justification for why that trade should go on. So I'd caution you, if you're using one market, especially a treasury against an index, you're liable to get caught in a lot of crazy upside down kind of trading.
Correlation is not causation.
Yeah, exactly. Yeah.
Okay.
Exactly.
All right, guys. So that's 30 minutes. So FT, as usual, I appreciate your time today. And guys, I'll post the recording on YouTube here a little bit later today. Also, I think this is the last AMA. We're going to skip the 1-2 weeks from now because I got a busy schedule, and FT is going to be doing a special webinar for us just a little bit after that for part of our 5-year anniversary on BMT. But if you did not get your question answered today, you can still use the AMA thread on BMT and post it there, and he'll take a look at it as soon as he can. Also, I just want to mention that since it is our 5-year, we have some really great stuff this year. As always, I've tried really hard. So this year we have, of course, Morad himself coming for a great webinar. We also have Linda Bradford-Raschke. She's here on Thursday of this week. And we even have Dr. Brett Steenbarger for the first time coming in a couple weeks, and John Ellers as well. So some really great webinars coming up for the 5 years, so if you guys can join. All right, guys.
Cool. Thanks for having me on, Mike.
Yeah, thanks, FT. See you later. Bye.